This is the Chicks of FinTwit, a finance podcast by women for everyone. I am your host, Caitlin Cook. Join me as I highlight female trailblazers and their male allies across the industry as each shares their expertise on a variety of finance topics. Nothing is off limits. Thanks for joining us. Now please enjoy this episode.
All opinions expressed by Caitlin Cook and the Chicks of FinTwit podcast guests are solely their own opinions and do not reflect the opinions of the host or any of their affiliates. This podcast is for informational purposes only, is not investment advice, and should not be relied upon for any investment decisions. We are not recommending any securities, nor is this an offer or sale of a security.
Hello, and welcome to the Chicks of FinTwit podcast, a finance podcast by women for everyone. I'm your host, Caitlin Cook, otherwise known as Dead Kate Bounce on Twitter. Super excited for our guest today. With us, we have Nicole Boyson, a professor of finance at Northeastern University, longtime Twitter friend, first-time podcast guest. Nicole, welcome to the pod.
Thank you for having me. I've been looking forward to this all week.
Me too. So I'm super excited for this one. I think there's, we talked about quite a few things that we can get into a little bit later on here, but just starting off, for those who aren't familiar with you, I know you've been teaching at Northeastern since 2004, but for the people, maybe just a little bit of an intro to you and into your background.
Sure, absolutely. So let's see. So I'll start not too long back, but so when I was an undergraduate major, I was studying accounting, and I decided to go work in public accounting, and I liked that. And I quickly found that most of the jobs I had just didn't satisfy me in terms of kind of lifelong learning. And so I worked in public accounting. I worked for a small investment advisor. I worked for a commercial bank, a smallish kind of savings and loan, and then back to public accounting. And all those jobs were great, and I learned a bunch, but I always felt like I wanted to dig in deeper. So when I was working with my clients in the advisory space, I wanted to understand sort of all the academic stuff that I had sort of barely learned in my undergraduate and my MBA program. And so I decided when I was 30 that it was a good time to just take the plunge. I'd been out for 8 years, and I applied to a couple graduate programs, got into Ohio State, which was perfect, only 2 hours from my home. So I moved away. That was my big move. I had friends who had moved from Korea and China and Europe. And here I was, 2 hours south, could go home for dinner if I wanted, but starting kind of a new life. And so I studied finance. 1998 was when I started, and I got really interested in hedge funds. Understandably, that was when long-term capital management blew up. And we saw all these really interesting things happening in global markets as well. And so there was something about that space that was just mind-blowing to me. Normally you just think we could buy a stock, you can short a stock, buy a bond, but in hedge funds, right, you can do so many other things. And so I got hooked. I started studying hedge funds, and that was what I wrote my dissertation about. Fast forward sort of 5 years ahead, I was lucky enough to get a job at Purdue for my first academic placement, but I quickly realized that it was a little lonely there with being single. And I met the man of my dreams in West Lafayette, Indiana, which is very rare apparently, but I guess I got the last good one. We moved to Boston, which is where he's from. And I was able to start my career at Northeastern. And so for him, he's a scientist, biology PhD, now working for a startup. But for him, it was a postdoc that brought us here. And for me, it was fortunately being able to get in sort of on the ground floor at Northeastern. So started there in 2004. I guess I got tenure in 2012 and was promoted again to full professor in 2017 or 18. And yeah, so I teach, I do research. I am really interested in a whole bunch of different things. And, let's just sort of let this conversation go where it will.
Oh, and it will. First off, love in West Lafayette. I can say that's definitely rare. So that's great. And I think there's a lot of ways we can go with this, to your point, right? I mean, and I kind of want to go in all of them because we do have time. Mm-hmm. And I think the first place to start, so for me, I was a finance major in college, and going into asset management afterwards, working for a startup now, kind of being on finance Twitter, as we both are too, just seeing different areas in the space, I just realized that there were so many things I wasn't taught. And that's not to say that, curriculums are ever going to be completely all encompassing depending where you're going in the space. But I'd be curious for your take on sort of the evolution of finance curriculum, because I'm sure that there's definitely a tricky balance with trying to stay more relevant to what's in the news, what's more recent and up and coming areas of the space with the more foundational side. And, we talked about this a bit before, but discounted cash flow statements, that sort of thing. Black-Scholes models. There are a lot of things that, it's good to have that foundation, but I honestly, and my finance professor that will probably listen to this, shout out to Jim Mahar, but a lot of the things that I learned in the formal curriculum versus what I learned, having conversations with people in the space, being on finance Twitter of all things, were definitely very different. And I think I'd skew a little bit more towards the Twitter side of things in terms of things that stuck and things that were more actionable. So curious for your take on the ground floor of how that's changed over time.
Yeah, it's such a good question. And I think about me, I studied accounting in undergrad, right? So I graduated in 1990, and I think I took like one finance course. I really didn't know anything about finance. And it was just one of those awful, like, financial ratios, and, you're just kind of crying quietly in the corner. And so that was fine. But as I kind of moved along, I think it's really interesting, your question. And I think the answer is, there are reasons for all of it. And so here's kind of my free form thoughts on this. So, undergraduate finance curriculum, you're absolutely right, has changed dramatically. And even since I've been at Northeastern, since 2004, it's changed. And it's mostly been additive, right? So it's not like we're taking away sort of efficient frontier, which to me is still like the most beautiful thing in the world. But, we're not taking away from some of those things, understanding corporate finance and discounting cash flows, and obviously things like present value are sort of fundamental, but we're trying to add in places where we think our students will benefit. So I teach a class in alternative investments, right, which is kind of an intro to hedge funds, private equity. We do distressed debt in there. We learn a little bit about workouts and that sort of thing. And so that's been kind of fun. Obviously, there are classes on derivatives. You mentioned Black-Scholes, and I'll only push back a little bit with you. I think that for you in your job, absolutely knowing Black-Scholes is probably not super relevant. And then I think about some of our other Twitter folks like Ben Eifert or Cam or Sem, oh my gosh, I'm forgetting your name. I'm sorry, Carson. Anyway, these folks who are like, they are in the thick of it, yeah, they're quants, Corey Hofstein, right? But yep. For them, I think, right, like, so it's super important that they understand fully the Black-Scholes model because they're trading options. And so I do think that it's really interesting. You can kind of learn what you need, and it's like cafeteria style, right? Take what you want and then push it back on the shelf. But then suddenly, I'm in grad school and I'm like, well, I better dust off the Black-Scholes model, right? For this theory paper I need to understand. And so I think it's been really important, I think, in business schools, particularly in this kind of era of, sort of data, right? So people now need to understand statistics a lot better than they did probably in 1990 when I graduated. People need to understand how to run code, right? So sort of coding and finance are now much more connected. And before it was like, maybe someone goes and learns Python or whatever, but now it's kind of essential to certain programs. And in fact, when we talk to employers, some of our students, in the last, call it 5-10 years, were missing out on getting some great jobs, not because they weren't super bright, but just because they didn't have some of those pieces. So data analytics or coding, or maybe just a little more math. And so it's been really interesting to see how the industry's evolved. But I agree with you. I think that many classes probably could be more practical. And a lot of that is professor dependent. So you get a great professor who's like, we're going to do a portfolio class and we're going to build portfolios, real portfolios, and we're going to actually study these things in a way that's meaningful to you versus like, here's the textbook, read all about it. And so I do think there's been a fundamental shift in universities in a good way. And partly that is just, it's a business and we need to be competitive. So we want our students in Boston to go out and compete with the best students from all the other fabulous schools in Boston. And so we have to step up our game. So I think there's a bit of that. And I'll leave you kind of on that thought with, well, I guess two more things. But the first is, if you really want to go learn hardcore stuff, get an MSF, get an MBA, and that's often very kind of focused on a particular area. But aside from that, I think, at Northeastern, we have a co-op program. So our students do 2 or 3 6-month internships as part of their college career. It's a 5-year program because of that, but they come out with actual work experience. And so that keeps us honest in the classroom, right? If students come back and say like, dude, this stuff is ancient. This stuff is old. We haven't used this in forever. It gets the faculty to think a little bit about, okay, sure, I'm going to teach you Black-Scholes and efficient frontier, and you need to know how to do net present value. But boy, let's find some applications that matter to you as students so that you can take those and apply them in your co-ops. And so it really, when it works really well, it's sort of a virtuous circle. When it doesn't work well, you've got students who are annoyed and checking out and faculty who are like, I can't keep up. And so it's a little bit of both, I think.
Oh man, so many things there. First, anyone listening to this that is a fan of the Black-Scholes model, it was the first thing I thought of, no disrespect. I do still remember it though. So something did stick. Maybe I'll use it later. Who knows where I go next. But to your point on sort of the beginning of that, it's really interesting to me that it seems like even since I graduated in 2019, and even since then, if I think about some of the students that I've talking to some of my old professors about the ways that curriculum's changed and things that they're looking to implement, talking to them about, what I think would be valuable from working in the space or, whatever. There's so many different things that are coming into this finance realm. And I feel like it's so much more all encompassing than we've ever seen before. And it's just touching so many different areas. So you mentioned computer science, you mentioned data analytics. I feel like the curriculum itself, to your point, is just being piled on top of time and time again. Then you add in, of course I have to throw out crypto, but there are so many different areas that I feel like are flowing into this kind of finance silo. And at some point, credit to any professors, because I feel like that has to be so difficult to kind of continue keeping up with while keeping a focus on the fundamentals as well. Just because as a student on my side, I feel like it's kind of would be overwhelming on that end, but to be the one on the back end building out these curriculums and figuring out what's important and what to teach has to be a lot to follow along with too.
It really is a lot. And I think it can get overwhelming. And it's also costly to change curriculum in the sense that, you're committing faculty to it, having them learn new things and building out a new prep or whatever, and then going and teaching. And if it turns out that you're chasing something that turns out to not matter, right, you've got kind of a little bit of an opportunity cost or a sunk cost there. So I think it is really important. But I also think that, trying to, like you say, trying to fit all that in, it really is impossible. And so the great thing is that students hopefully get those kind of foundational classes in some way, and then can pick what they want and choose some electives. And I think all the universities, including us, are working really hard to make curriculum more flexible, sort of more bite-sized, fewer prerequisites, more electives. And so I think that works really well for kind of this generation of students who were raised on sound bites on TikTok, and a 4-minute video feels long. And so I think that old day of just like walk in and tell war stories. Most of my faculty, thank goodness, are not like that. But you always find the occasional faculty member, and you're like, buddy, like you haven't dusted off your curriculum since, it's been 40 years. Like this is not, the Korean War anymore. So like maybe you should move along. And so I think there's a little bit of that as well. The great news is most people who go into academia really do love learning and they love research. And even the ones that aren't necessarily going to be that excited about teaching, or maybe they're nervous about it or just learning it, there tend to be really bright people. And if you go to those classes, even if their style is a little bit dry, you can always learn a lot from them. And that's something that I tried to tell myself when I was doing my MBA at night and taking classes till 10 p.m., like just power through this, right? There's stuff to learn here. So I think, but I think you're right. I think it's pick and choose. And the interesting thing too, is if you go back and look at something, you'll think, okay, now I get why I learned that. Even if at the time it felt completely just like, what is this? So.
Yeah. And I think, I'd begrudgingly say too, that I think just having that holistic view of the entire industry rather than initially being siloed, it's like how I'd explain why I think that working in operations is super valuable as well, right? If you see how things work on the back end, see how everything connects, and see how the whole industry kind of operates in harmony with each other, sort of from one point to another, and understand how all of that information and the data flows and the money flows and whatnot, you're going to understand what you're doing much better. But at the end of the day, no matter what your job is. But for students, and I know this is a tough question because it's obviously very situationally dependent, but along the topic of being a lifelong learner, working in the space, to becoming a professor, to updating your curriculums, and things are just moving so quickly at this point. For those who are looking to go to school for finance, if they're looking to learn more about the space, what areas do you see the most promise in moving forward across the industry that you recommend people look into? I know that kind of depends on personal preference and different skill sets and whatnot. But what are you most interested in looking at the landscape as a whole?
It's a great question. So I think there's always room for so let's split finance into sort of corporate and investments, if you like. So the corporate side, honestly, is always going to be there. So, GE is always going to need analysts. Big firms are always going to need folks to do the kind of work that they do, budgeting and planning. And, that's where finance and accounting kind of overlap. And I think those are good jobs. They're good careers. And they change in the sense that companies change. So you have to be nimble and, learn how to use software and work with other people or whatever. But the actual finance work, right, is pretty nuts and bolts. I think the other side where you see massive change, which is really where most of our FinTwit kind of folks are, right, is in the asset management side, whether it is sort of doing what you're doing at a startup that's focused on kind of something very new like crypto, or whether it's kind of old school, these giant firms. I live in Boston, so we have like Fidelity and MFS and Putnam. I mean, these firms have been around forever. Wellington Management, right? And those firms, it's interesting when you think about kind of change and where things are going. Just tracing those firms and the way that they've moved into different spaces, some successfully, some not. Putnam used to be, as big as MFS and call it, no one was ever as big as Fidelity, but call it big as MFS or Wellington or whatever. Putnam has failed to keep up. I have friends who work there. Like they're smart people, but they're not moving with the times. They're not moving sort of, for example, in the old days, brokers sold mutual funds. In the new days, investment advisors use mutual funds. And so smart fund companies were able to adapt and say, let's make our shares available to both the brokerage side and the advisory side. And Putnam took a really long time to do that. And so kind of watching firms and how they change and adapt is kind of interesting. But when I think about kind of where the future is, I think that employers in the investment advisory space or in the asset management space or in the quant space, which is massive and exploding and huge, those employers really want people who can sort of do everything. So it's a hard bar, right? You need to be obviously very skilled with, understanding the basics of finance, understanding your way around a spreadsheet and all that sort of thing. But that only gets you just sort of barely not even to the ground floor, right? These employers want students who are able to work with big data sets, who are able to analyze data in ways and not just run code or run a regression, but really sophisticated sort of putting data sets together. I mean, half of my work as an academic researcher is not running a regression. Like that's pretty easy. It's figuring out which data I need and which variables are important and how to understand what to study. And those are things that you can kind of learn, right? But you also learn by being immersed in a job. And so I think when I talk to employers, they're looking for students who are adept with data, who are comfortable sort of in a situation where, hey, we're running this model, we're trying to understand this factor or whatever, go read 10 academic papers or go talk to these 10 smart people and figure out what makes sense and figure out how to think about it. So you also need this sort of, you need to use the tools and know how to use them, but you also need to be kind of a creative thinker. And so I think the classes that prepare you for that, they really are the classes that are kind of intense and hard. Like go learn how to program, take some hardcore math. It's weird. It feels not super applied, but once you're kind of putting those things together, it turns out that the finance part isn't always so hard, right? It's the math and the theory and the computer science behind it. And so I think for students to come out and just say like, well, I know the basics of finance is perfectly fine for many jobs, but to really take that next step, employers want students who've got this sort of data analytics skill. And again, I don't even always know what that means, but for different firms, it means different things. But if you know your way around data and spreadsheet and you understand how to look at trends and look at opportunities and being current on what's happening in the world is helpful as well, right? So I admit I'm behind on crypto. I've been working to understand it better. It's for some reason hard for me to learn. So crypto is one example where you can have a niche, right? I mean, that's what you guys are doing. And it's sort of finding that, what are you good at? What do you like? Your point about operations could not be better taken. Most of my students that co-op, their first job will be sort of in operations, right? Because that's a little back office. They're not going to put a sophomore in front of a big client, right? So they're doing that work. And the students who sort of say, I hate operations, I don't want to do it. I mean, that's fine. Like you might find it tedious, but you better understand it if you're trying to run some kind of business, right? So I agree with you fully there.
Yeah, I think it's just such a strong foundation too, where it's like, I personally can say I didn't start in that. And the more that I think about it, I sort of wish that I had. I did like a summer internship that was a little bit more operationally based at HSBC, but other than that, I really didn't. And anyone that I've talked to that started from that foundation has, I feel, a much better understanding of just all of the groundwork that you need to really understand the business from beginning to end. So definitely agree on that. And I think there are a lot of different ways that I was thinking of going with this right now. But I think that, one, to your point, lots of different ways that you can go in terms of actually what you want to do with your life. But I think the hard stuff in doing that in college is super important. And that's something that I wish I had done a little bit more of, honestly, as well. Not that this is like a Caitlin's regrets from college.
Well, also, Caitlin, it is, I mean, you are young. You have lots of time.
Oh yeah, no, there's definitely time, but I just, it's just funny to think back to, because you're so right, where, if you do the difficult things while you're in school, you're set up so much better for the real world as well, just in the real world, but because it's all going to be new to you when you're out there as well. And it's either you dig in and you try things and you figure it out, and you kind of have to like brute force your way through it all, and figure it out as you go. And you want to start that early. You want to start doing that in school. I just think of the financial modeling class that I did in college that I think I did for 3 weeks. So sorry to mess around that one, but definitely agree there. And this sort of brings me to another point we talked about offline, which is this huge debate around CFA and MBA. So I guess for listeners here, I mean, obviously, Nicole, you have a master's, right? I did part 1.5 of CFA, knew I didn't want to do MBA. I feel like we could be on different sides of the argument here if we did it that way. But this has been a long-standing discussion between people across the industry, people talking to students. My student-run investment fund in college used to go visit different offices. And that was a question we asked everyone we visited. And the answer was always different. And it always depended on whether the person that we were speaking to had their MBA or not, a lot of cases, which I thought was pretty funny. But coming from the academic side of things, what's your take on CFA versus MBA? I know that it's probably situationally dependent and there's some nuance there, but curious for your thoughts on, what you'd recommend.
Oh, for sure. And so, like for people like me who go get a PhD, you sort of go, okay, like now I'm hyper educated, right? So I'm this hyper educated person. And it's to some extent that gives me, I think, slightly better perspective on a lot of things. And so I'm going to digress for just a second here, because I think this is important. And we didn't talk about this at all, but I'm thinking about my kids going to college, right? I have a 14-year-old and a 13-year-old, and I'm hyper educated, right? So I have 3 degrees, but I went to Kent State University for undergrad, like bravo, Kent State University, right? Little school in Ohio, well, big school in Ohio, small town, big school. And I had offers from 3 of the big 6 accounting firms. Like, you don't have to go to a super expensive school. And this is one of the things that I preach a lot to people, because I live in this kind of swanky town with lots of people who went to fancy schools and who are really concerned about where their kids are going to go to school. And I really strongly believe that unless you're studying something really specific where that school is crucially important, honestly, you go to the best school you can afford. And so I think a lot about that when I sort of talk to my friends who are worried about paying for college. My kids can go to Northeastern for free. Well, they have to pay room and board or whatever. And that is amazing. And maybe they will. I'm fortunate. My kids have choice. They can go to school wherever they want, wherever they get in, whatever fits them. But I think it's really easy to be hyper focused on where you go to college. And again, unless you're in like the top 15, 20 schools, or, hey, I want to study at Harvard Law, so I'm going to go get an undergraduate degree in philosophy from Princeton, or, you're building your resume at sort of the swanky schools. And that's important, and you can do that. But I think, when you're just thinking about straight up undergrad, I think it's absolutely acceptable and appropriate to go to school wherever makes sense for you. And I say this because I know parents sometimes listen to these things and worry. And maybe because I'm so hyper educated, my perspective on it, I hope, is a little bit better. That sure, like my PhD's from Ohio State. That's a fabulous school. I'm very proud of that. But it didn't really matter much that I went to Kent State for undergrad in terms of getting into a good PhD program. I had great jobs with just my undergraduate degree. And guess why? Because I studied a commodity, studied accounting, and because I was a really good student. And so like, that's the other thing, right? If you go to a really fancy school and you're spending all this money, your parents' money or whatever, and you're getting C's, like, I'm sorry, like you're not going to get a better job than that A student from Kent State University. And I think a lot of people think, oh, it's just the diploma, my grades don't matter. That might have been true in the good old boy network like 40 years ago. It absolutely matters now. My students who get co-ops, there are minimum GPA requirements. Firms won't talk to you if you don't have a 3 whatever. And so I'm not suggesting that everyone has to go get a 4.0 and that I didn't screw around in college a little bit and get a C or two. But I think it's super important that when you think about college and when you think about master's programs, which I promise I'll get to in 1 second, all of these are really, really relevant. So at the end of the day, it's figuring out what you want to do. And if you want to study something that's a bit of a commodity like business, then go to whatever school you can afford. I don't see this as a problem. And work really, really hard. That's my second thing that I get worried about. And again, I did screw around some in college. I was not a perfect student, but my grades were good enough and I did well enough that I was able to get good job offers. And I think that's really, really important. My second thing, to really directly answer your question, but I led in with this because it's related. I think at the end of the day, the CFA versus MBA argument or MSF argument, of course, it is sort of situationally dependent. But if you are in finance, and if you are in asset management, it strikes me as a CFA making probably the most sense. You might not need either, by the way, which is totally a separate thing. And I don't necessarily think you do. But, again, I think that if you know for sure you want to do the asset management stuff, a CFA strikes me as the most obvious thing in the world. If you don't, or if you want to do something quanty, or you're really interested in like, hey, I want to go out and work on, some kind of vector models or something, then you go get an MSF at the best school you can find. That kind of might matter, right? So one of my prior students just got into UC Berkeley, and like, that's huge. It's a quant finance program. It's great for her. She didn't get in the first time. She tried again. She got in. Like, so that's amazing. For her, like, she lives and breathes that stuff, right? Like she runs code all day long. She's a mathy person. That's a perfect fit for her. And so again, I think the big mistake always is blindly doing anything. But if you're going to blindly do something, frankly, sorry, Northeastern, it's a CFA, because the CFA is very clearly recognized and it's standardized. An MBA, obviously, you learn a bunch of stuff. It can be tremendously useful. But again, the signal is super important. The CFA, you can be poor kid from wherever or rich kid from wherever. You get a CFA, you have the same credentials. An MBA, right? So much of it is going to be class dependent and legacy dependent. And could you get in and what could you afford? And so you're already at a disadvantage, I think, if you're not a super high income, come from a super high income family and can afford that. So to me, the MBA, absolutely, the material you learn is awesome and cool and it's fun. The CFA, bang for your buck, has got to be better. All that said, there are plenty of times when an MBA makes sense. And I think these specialized master's degrees are particularly nice. So more and more schools are doing like a 1-year Master of Science in Master of Science in Finance, a 1-year Master's in Data Analytics, a 1-year Master's in Computer Programming or Statistics. Those kind of add-on sort of things can really add value. So you get a 4-year degree in whatever your field is, and you think, I really want to get a job at this consulting firm or this analytics firm. I'm going to go get an MS in computer science. Take me a year, cost me, I don't know, 50 grand or whatever, probably better return on investment. So if you don't know what you want to do, I wouldn't first thing start applying for $200,000 MBA programs.
No, and that's such a good point too, because I mean, the cost is huge. And usually in that time of your full time, right? How are you earning income at that point as well too? Whereas a CFA, I was studying while working, and it's definitely something that you can kind of work around in your own schedule rather than say a class, but yeah. Lots of important points there. I think the one that you mentioned towards the end is, and I'm curious from like the academic side if this is actually true, but from the outside looking in, seeing the changing, advertisements from different schools, being on the end of those targeted emails all the time, which
yes, of course, you're the perfect age. So.
Yeah, don't plan to get my MBA anytime soon, but you never know. I see more and more of those specialized master's programs that you mentioned. And I feel like that's an interesting shift where they're getting more and more niche or niche, where are just more specific within different areas of the business, where it's almost like you're specializing. And I think that, at least from my perspective, if it's like looking at different options, to your point of your student that was looking at more of like a quant program, if that's exactly what you want to do, then it's sort of like with undergrad, if you didn't have to take all of the kind of other other areas of the curriculum that you don't necessarily quote unquote need for the area that you're going into, right? Like I went to a private university, I had to take some theology classes. I mean, it was a great time, but if it's like going into that curriculum that I signed up for the finance program and not having to do anything outside of that and really just diving headfirst in. So I think that's an interesting idea that we're seeing more and more of those programs pop up. And I could see how those would be, when you're looking at your options rather than just picking a program that picks you, is like looking at something that's a little bit more specific to the area you want to go to. And I feel like that would provide a lot more value if you're looking at different programs. Just my take.
I agree completely. And I think a lot about, when I was an undergrad, I remember being frustrated because I had to take like philosophy and all these things. And I look back and some of those classes were awesome and some of my favorites. So I think it gets tempered with age, but it also brings up a really interesting point of sort of college as a trade school, right? And so I always thought studying accounting was not so different than becoming a plumber or becoming an electrician, because you're learning this very specific skill set. I could always hang a shingle right now and do taxes or help people with their books, right? Like I wouldn't be like my dream career because, I'm okay at that stuff, but it's not my favorite thing, but I could do it, right? So, and I think that's a really important philosophical question about college in general and master's programs specifically is, why do we send our kids to college? Is it sort of the theoretical, kind of hypothetical liberal arts education where you're really learning broadly and learning how to think? I think that's beautiful, right? I mean, I work in a university. When I was 18 and applying for school, I was like, dude, I just want to get a job where I can make some money. I was first gen. So my parents certainly were not thinking about like, oh, go learn philosophy. Like, I'm sure they appreciated that. And some first gen parents might. Mine were more like, go find a trade, And so I think that philosophy about college changes. So now I'm mom who can afford to send my kids to college and they're second gen now. So I'm like, go wherever you want, study whatever you want. And so it's a very different perspective. Both are valid, by the way. You don't always have the luxury of the second one though, right? Sometimes you just got to go get a job. And so I think that sometimes for master's programs, it's not so different, right? It's like, well, I'm going to go get an MBA and study this stuff and, whatever. Or maybe you go and get an MS or an MA in something like fun, like philosophy or English or religion or whatever. But I think the way that we think about these master's programs at Northeastern are these kind of bite-sized, we even have these certificate programs, which are like, 4 classes, go learn about HR. And then if you're a working professional and you've been out of school for a while, maybe that helps you get that promotion. And so again, really trying, I think universities, it's both. We would like more revenue because we're a business, but also we would like to tailor our programs as best we can and not have that just be sort of like lip service, right? Like the MS in analytics, hopefully we're not just cobbling together classes from places and slapping a label on it. Hopefully we're thinking hard about what goes into that curriculum, hire a few new people, put a few new pieces in there, and then make it a little bit more useful. And so it's that constant interaction with industry folks and what we see our students needing. But I agree with you. I think these specialized programs are super interesting, and particularly for people who already have a background in finance or business or whatever it is, you can jump into those without too much prep work.
Absolutely. And you might have me thinking about one of those after this episode. You sold it well. College is great. I love that. Specific to kind of your teaching expertise, I know you mentioned a lot around the alternative space. We talked offline about research in hedge fund activism, and so on. So curious to get into that a little bit in more of your area of expertise. Is it specific to just alternatives, or are you kind of, I guess, what do you teach? I should have started there, but we'll go there now.
Oh, it's fine. I mean, when you've taught as long as I have, you teach everything and you teach whatever they need you to teach. So I've taught investments and I've taught, intro and courses like that. But the 2 things I'd love to teach the most are my alternatives class, which I change every semester. We add a few new things. And again, it's what it sounds like. It's everything that's not like stocks and bonds. And then I teach fixed income, which is also great to teach because it's kind of a macro, I don't call myself a macroeconomist by any stretch, but there's sort of this macro view of the world when you teach fixed income, because you're thinking about really big things like interest rates and inflation and what's the Fed going to do and how does that monetary policy interact with fiscal policy. So you don't really get into politics, but you get a little bit in because it matters, who's in the administration, how do they think about fiscal policy, how do they think about debt? And so, and what are you faced with in the world, right? Like we have a war now that was not expected 6 months ago. We had COVID, that was not expected. And so kind of the macroeconomic impact of all these kind of external shocks that happen to the system are really fun to study in fixed income markets because you see these immediate impacts on sort of risky debt, safer debt, sovereign debt, international debt, and so forth. So that class has been just a great deal of fun to teach. And it also has a lot of cool math in it. You learn about convexity and duration and all these sorts of things. So that's those are great classes to teach. Interestingly, I don't do any research in fixed income. I have a couple papers on banking, and I think those come a little bit from my own interest in having worked at a bank. I have a little bit of work on sort of regulatory arbitrage and how banks try to game the system in particular ways with respect to their capital structure. And so that stuff is super fun to me. That's really straight up corporate finance, but also kind of with the fixed income twist. But the two areas I've worked the most in, the first, hedge funds. My initial work was very broad. So I've been very lucky in the sense that I've been able to pick topics that are kind of, I don't know, how do I say this, up and coming. And so when I started learning about hedge funds, I was just near the front of the game. So I was able to work with a lot of really high level faculty that otherwise I might not have gotten to know. So some of my co-authors and some of my, just informal advisors in that space. And I was just broadly interested in things like risk and return and manager skill and all the really basic stuff in asset management. But I kind of quickly moved into activism, and hedge fund activism I probably worked on that topic for 7 or 8 or 9 years and studying different aspects of it, trying to understand when an activist goes into a firm, what happens? Is it good for the firm? Is it bad for the firm? Is it long-term? Is it short-term? And so that's been really fascinating for me, I think for 2 reasons. The first is that I'm a little bit of like that nosy Nelly who wants to know what's going on all the time. And so getting to read these documents is like a window into the thought process of some incredibly smart people, some of whom seem like really lovely people and some of whom seem like complete jerks. But you read the stuff they write, you watch how they approach the firms that they target, and understanding that process to me is not only just kind of fun because the letters they write are pretty funny and interesting, but also just thinking about kind of like what's their goal and how are they trying to make this work. And so I think that holistic kind of big picture view about, you've got a company and it's running and it's maybe doing okay and it's maybe not doing okay. And then you have some kind of outsider who ends up being a shareholder, a decent sized shareholder coming in and like yelling at you and telling you to fix stuff. I think it's just interesting to see how that works. And so the things that come out of the activism research, to summarize it, for those of you guys who don't like study hedge fund activism, there's kind of 2 things we know for sure. And I have some work in all these spaces, but there are now hundreds of papers in the space. The first thing we know for sure is that when an activist enters a firm, buys 5% of the company's stock or more, the stock price pops. So you get a stock price pop on average, call it 3 or 4% over a 5-day period. And over a 20-day period, it's maybe 7%. And this is like in excess of the market, right? So you get this sort of really big, what's the word? Excess return. I don't know, it's the word I use all the time. Abnormal return. That's the word I want. So you have this big return. So we know for sure that happens on average. And every study that's ever studied activism finds that. The only other thing we know for sure about activism is that when an activist comes in and targets a firm, the probability that that firm is going to be bought, it's going to be subject to a merger, goes up a lot. And so that's the other sort of place where activists make money. It's not so much that they buy the firms themselves, although they sometimes do, like Carl Icahn's bought himself a firm or 2. But most of the time, they encourage a merger. They're identifying a target that no one thought of, and they kind of create interest in this firm. Sometimes I'm sure behind the scenes, they're helping broker the deal. But there's this stock price pop, probability of a merger goes up. Oh, the third thing for sure, heads are on the chopping block. So management gets fired all the time when activist comes in. So as a manager, you're running your company, looking over your shoulder for Carl Icahn, right? It's kind of stressful. But what we find in the space is that on average, activism does seem to be, on average, good for firms. We see improvements in operations. We see, again, sometimes management getting cut is not the worst thing in the world if the management was entrenched or a little bit lazy. Boards get turned over. So you see kind of this fresh change. And again, on average, sometimes activists come in and do a terrible job. Sometimes they come into firms that frankly don't need the help. And sometimes they're short-termer. They'll come in and say, pay a dividend, and then they pay a dividend and they go away. That kind of stuff is happening. But the typical activist event, the activist is around for like 2 years. You do see these changes that seem to matter. And they seem to be, on average, kind of good for stockholders. So I think just understanding that is a really big corporate finance question. And it's super interesting, important question that we're still trying to answer. Where do these changes come through? What happens when activism goes bad? And all those sorts of things. So that's my first kind of topic that I think a lot about.
Oh man, well, I see why you researched that. If I had to research something in that realm, I'd probably do the same. And you took a couple of my questions and at least started on answering them as well, which is one, I was going to ask if you've seen that activism as a whole is a net positive, which you answered yes. But to the second point of what you just mentioned, where does it go wrong? I feel like you just see the headlines, right? And if you're not actively doing research in the space, you kind of hear about these stories a little bit as they're happening, but a lot of the time after the fact, when something goes awry or something goes well. But where does it often go wrong?
Yeah, so the really interesting side, I love that you asked that question. It can go wrong in some ways that are sort of preventable, right? Like the activist goes in and the target firm is absolutely not interested and unwilling to cooperate in any way, shape, or form with the activist. So I have a paper called Hostile Resistance to Hedge Fund Activism. And I find that when firms are super hostile in return, they do things like worsen their governance, put up poison pills, make it harder to get a toehold in the firm, which again, I get it. You don't want your firm messed with. But we find that on average, that's not great for shareholders. Usually the activist kind of goes away and the firm tends to sort of flounder. But the more interesting question, I think, on that is what about other stakeholders? So, right, is everything like if the world is a zero-sum game, if an activist comes in and shareholders kind of win, right, the stock price goes up or whatever, what about everyone else? What about employees? What about suppliers? What about bondholders? And so it's interesting. So folks have studied that, sort of the other stakeholders, and there's kind of mixed evidence. So what we see, I tend to be, I'm an academic, I have strong views, but I'm also super nuanced. And so I think on average, activism is probably good for most stockholders on average. But is it always good for bondholders? Not necessarily. One of the things that happens when activists come in is they often will kind of use up excess cash, maybe increase debt. Now, increasing debt, your corporate finance, right, can be good, right? Debt is your friend, it's tax deductible, you need to grow. But if debt gets increased too much, obviously you increase risk of bankruptcy. So that tension there between stockholders and bondholders is really important and can bind sometimes. So there's some mixed results on bondholders. It looks like sometimes they're better off, sometimes they're worse off. In terms of employees, not a great story. So hedge funds activists come in, firms tend to become more efficient. Efficient sounds great if you're a stockholder, does not sound great if you're an employee, because now you're Amazon and you're driving your truck all around at 4 a.m, or, you're running your plant till 3 a.m, and maybe safety conditions aren't good. So, lots of things can happen to employees that isn't great. Now, it could be that maybe the employees should have been working harder and now they are. We can't possibly know that. But on average, right, there are more layoffs, not just top management, but on average for the typical employee in a typical firm targeted by an activist, it's not always a great outcome. And so that's kind of interesting as well. And so I think trying to get a sense for all that, is it good for the environment? That one we don't know. So activism is fascinating to me. We've got this guy, Jeff Ubben, who was a hedge fund activist and now is running a firm that's like an environmental kind of activist firm. The super smart guy, right? And he's out there sort of now trying to do good. And I think he was a softer, gentler activist from the start. I don't have any doubt that he could raise his voice in a boardroom, but he was the kind of activist who would get involved with the firm, get on the board and stay there for 15 years. So he acted more as a partner, I think, than a catalyst, or more as a partner than as a hostile sort of activist. And his style, worked for him in activism. And now he's trying to take that to sort of the environmental side. So that's been really interesting to watch. And I think that crossover between activism and social activism is just interesting. I'm not going to study it academically, but I just find it to be, I don't know, kind of promising. I don't picture Carl Icahn anytime soon, like jumping on the green bandwagon, right? But some of the younger activists, the more recent ones, there is a balance in the activism, and you don't always have to use a hammer. And so that's the change we've seen over time as well. It's less aggressive, less overtly hostile, I think, than it used to be. And I don't know if that's good or bad for firms, but it's sort of a trend in the space.
Yeah. And my follow-up on that would be to your point around sort of incentives. You talk about more social activism, which you can see if you're fighting for kind of a better take for a company on the environmental side of things, I could see that being, a little bit more rosy and positive than some of the other activist stories you've heard in the past. Obviously, financial incentives probably the biggest driver, I'd assume, for a lot of folks. Sure. But are there others out there other than the sort of environmental angle and the obvious financial gain that advisors or activists are looking to gain? Like, what other drivers could there potentially be for why they're doing what they're doing? And I haven't studied this to disclose that.
Oh, that's okay. I mean, I think you end up in just really interesting places where activists might get involved with the union, for example. So obviously firms that are unionized are going to look different than firms that aren't. And so whether the activist is kind of on the side of the union or trying to bust the union, right? Those two things are going to matter a lot in the way that the activist is perceived. And so I think more work needs to be done in this space. I tend to work on something for a long time and then suddenly become very tired of working on it. So I'm still really interested in activism, but the thought of reading a 13D filing makes me feel like crying because I've read so many. And so I'm not going to do any more research in the space probably, but it's fun being someone now. I discuss papers, I read what I can. I occasionally talk to the media because you see these patterns in the space that are interesting. And so I do think you're right. I think we've got sort of, when you think of ESG, if you like, right? The hedge fund activists care a lot about G. Governance has always been crucial to them. They probably were more hostile to the E and didn't care much about the S. And so you're seeing a little more movement into that space. And if you can think of the world as sort of roughly categorized into those three different buckets, I think you see activists now recognizing that they better at least have something to say about all of them. Where before it was just like, oh, your board's terrible. Oh, your manager's entrenched. Oh, get rid of the corporate jet, right? All the governance stuff. The other two, well, the corporate jet probably good for the E, but unintentionally so, right? And so those sort of things are much more salient. The interesting thing is whether there's greenwashing in activism, just like there is in, all these different ESG indices. That's something I'm sure someone's looking at, and I don't know the answer yet, but I'm sure the answer is yes, a little bit, right? Cheap talk is cheap talk. And that's been consistent since, I don't know, the 1700s probably.
So if you're done with the hedge fund activism and reading all of those reports and whatnot, what's next? Where's the next area of research for you?
So I've been working for a few years now in the investment advisory space. And I always like to tell a little bit of the story why, because I think it's kind of funny, but I used to work for a broker in 1996. It was my third job out of college. I was a little bit older than you maybe, right? I was pretty young. And I met this guy. He was a friend of a friend, and he knew him from tennis or whatever. He's like, oh, I run this small firm and I do pension consulting and I also do investment advisory. And, I'm a broker. So I went to work for him. There were like 6 of us in that firm. It was a tiny firm. He was loaded. Like he had a pretty good book of business, and he was mostly a broker, but also a registered investment advisor. And so, the difference, right? Brokers sell stuff and get a commission. Registered investment advisors are fiduciaries, they advise, and they typically get paid differently, oftentimes percentage of assets. And so he did both, like fine. But I quickly learned that he was a really bad guy. And so he would lie to his clients. He would tell them, oh, I'm selling you this mutual fund, but it doesn't cost you anything. Like clearly the guy's this giant house and this nice office and the whole staff. Like he's making money somehow. So it must have cost something. And so his clients just liked him. You know, they played tennis with him. He remembered their birthday, whatever. So he was just a bad guy. He was the classic, typical broker that you see on a movie that was made in the 80s, you know, sell on the phone, whatever. He was also kind of dumb and he was sort of unethical. And so I worked for him for like 11 months. I really hated him. I got fired because I wasn't very nice to him and told him I thought he lied to his clients. And he also gave me a crappy bonus. Like, it was a whole thing. So anyway, I got fired. I don't know, 4 days later, I have a job at Ernst & Young. And then I moved. So I moved from that brokerage side of the business to the investment advisory side of the business when I was at Ernst & Young. But the bigger story about working for him was not only did I think he was just like this horrible guy, he had a very bad image of kind of brokers, which I have learned now is probably mostly wrong. But I learned so much about mutual funds working for him, I can't even begin to tell you. So I understood how they were sold and what the different share classes look like. Talk about operations, right? So like, I understand the operational insides of a mutual fund. And it took me like 4 or 5 months to understand it, which made me realize that the mutual fund business is kind of shady in the sense that fees are kind of hidden or poorly disclosed. And so with all this backdrop, I've always been interested in managed investments, hedge funds, and so forth. And so I started thinking a little bit about mutual funds because I'm in that literature, even though I don't write many papers about it. And I was like, you know what? I need to understand kind of what's going on in the mutual fund space. I was thinking about brokers like him. And I knew that fewer and fewer mutual funds were being distributed by brokers, and more mutual funds were being distributed by fiduciaries, registered investment advisors. And so I had this really great graph from some industry report that showed that very starkly. It was like money flowing out of the broker sold and into the advisory. And I was like, this is Christmas. This is the greatest thing in the world. Investors they're better off. They have fiduciaries. So I started trying to understand that graph. That was the impetus with my prior boss in my background. So there's that. So I start reading and learning about this, and I realize that it's the same dude selling the broker sold funds and the institutional funds, because 80% of investment advisors are dual registered as brokers and fiduciaries. And I thought, well, that's a conflict waiting to happen, right? So like, what in the world's going on here? So I ended up kind of digging into that side of the business, turned into a paper that I am needing to send to a journal soon. But this paper basically looks at dual registration, and it looks at the conflicts that arise from the virtue of being a dual registered advisor. So if you're a dual registered advisor, you wear 2 hats. You can be a broker for one client. You can be a fiduciary for another client. You could conceivably have the same client, one with a brokerage account, one with a fiduciary account. So you're supposed to be behaving differently for these 2 clients. Notably, for your fiduciary client, you should be acting in their best interest. But what I found was that many fiduciaries in this space that are dual registered have all the same conflicts of interest that they have on the brokerage side of their business. So they double collect commissions and fees. They collect revenue sharing, which are just like random big payments from mutual fund families to the firm. And they're much more likely to be disciplined for this sort of behavior. And I was trying to understand that space, what was happening here. And effectively, the other piece of it is that on average, those dual registrants are using those same mutual funds, many underperforming, kind of actively managed expensive funds, for their institutional or their registered investment advisory fiduciary clients. And so it's a little bit of I change my hat, but I'm running my business the same way. And I wanted to document that because I think it's really interesting and important. Now, I don't think that these are on average like bad guys. I mean, my boss was, but there are a lot of really decent people in this space. It's just, this is how they're trained. You come in, you're 23, you go work for one of these big brokerage firms, and they tell you, you can be an advisor, you can be a broker. As an advisor, you'll make more money, by the way. These smaller clients get charged more on average than they did when they were brokerage clients. So there's that. But they also don't, I think, really help their advisors understand that when you're a fiduciary, you're supposed to act in your client's best interest, not just change your hat. And so I think there's a lot of hat changing going on. And I just wanted to document that and the impact that it has potentially on retail investors. And so that's what I've been working on for like 3 years. I'm expanding it to a sample of 401k plans because a lot of these same dual registered advisors also advise 401k plans. So I'm trying to see if some of the same sort of conflicts kind of seeping into that space as well. Very new project. I'm just collecting the data now, but I'm very interested in general in this idea of conflicts and kind of investor welfare.
Yeah, and that's fascinating too. So please let me know when that's out, because I don't say this often, but I would love to read that. And it's coming from working with brokers as well as RIAs and fiduciaries, if you will. It's like there's so many built-in conflicts of interest, I think, right? And that's an industry problem. It's more of how do we navigate that? What can be put in place to keep that in check? And I don't know what has or has not been done to do that, but it's the research like what you're doing right now that kind of sheds a light on that. So super interested to read that whenever it's released. I love that. Definitely a labor of love too. It's been at least 3 years. I'm assuming that's probably a norm on the research side of things where it's a little bit more over time, but I'm super curious about that when it's out. But I do want to wrap things up here. I know we could probably talk about this all day as well. We can have you back sometime. I would love that. But I do always ask the same questions of my guests at the end, and it's nothing finance related at all. But when you're not writing research reports, when you're not teaching, what else do you like to do? What do you do with your free time as a Nicole, not as a professor, not as a researcher, outside of that?
So I'm a little Energizer Bunny-y, so I tend to do a lot of things. I have a colleague and I call him that, but I think I also am. So I tend to do a lot of things. So I'm involved with a couple of different boards, like board of my church and the library. I've been subbing a little bit in my local, my son's school here and there to help out because COVID. So those are kind of like, I always have like 3 or 4 kind of just random things that I think are fun that I like to do. But mostly what I really like to do, I like to spend time with my kids, my family. I like to be anywhere near water, even though I'm not like a big boater. I'm a big fan of the beach. I'm a big fan of just being outside and outdoors. I like to walk. I like to do that with other people. So I'm incredibly social as well. And the things I'm learning to like now, which I giggle about because I'm now like going into the dad joke phase, and pretty much everything I say is a dad joke now. It's a little terrifying, but yeah, I'm really interested. Like the last couple of years, COVID has made me very interested in my garden. And so I have a flower garden out front. It's lovely. And it's a labor of love, and I plant it every year, and I hang out there and water it and talk to my neighbors and meet all their dogs. We have a vegetable garden that my husband tends, but the flower garden's really fun for me. And I think the other thing I really am really kind of interested in, I can't believe I'm saying this in public, is I need to learn more about birds. And so I told you I'm accelerating my old age. So I was walking the other day, and one of the lovely ladies in my town, she's like, here's the book, you need binoculars. So I'll keep you updated on that. But really for me, it's being outside, it's doing things that aren't finance things, being with my family, being with my friends. And I don't have any specific hobbies. Like I'm not like an avid video gamer, or I don't, ride my bike 300 miles every week. But I think it's just sort of being active, being about, and really trying to be more involved with my community where I can. So that's kind of where these little boards show up, and helping a friend who's running for election. I'm her treasurer. So like all these little things that I think connect you with your larger community, but also are just kind of fun to do. So
I love that. And to your point, doing things outside of finance. And as I always say, getting outside. I did not tell Nicole to say that or anything. So perfect. I will need you to keep me updated on the birds. I'm not going to knock you and saying it's like accelerating your old age by any means. I feel like every time I go outside, I see some birds, and I've even been like, what is that guy?
So, oh my goodness. I think I'm blind though. So when the older lady said to get binoculars, I was like, dude, I'll be having the binocular. I will be very laden down when I go out, but I'll be able to see them hopefully.
Yeah. That's a good new hobby for you. So, no, I love that.
So. It's so embarrassing that I said it in public, but there we go.
Hey, no, you got to speak your truth. And I'm sure that there are people listening to this who also are a fan of bird watching. So no judgment here. But thank you so much for being on today. This was great. Again, I'd love to have you back. And I feel like we could talk about a lot of the research that you've done in more depth too, because I am selfishly very curious about it as well. But for those listening to this, where can they find musings from you, find your research, if they're interested in reading a bit more after this, like I am?
Yeah, so for sure. So a couple of things. I'm easy to find on Northeastern's website. So Nicole Boyson, just search me up, search up Nicole Boyson Northeastern. You'll find my homepage that has my updated vita with my research, a little bit of a biography about me. The other place, which I should have said first, is Twitter, my favorite place. I'm Nicole Boyson there. My tag is at Nikki R1, NIKIR1. The R is for Rickstalis, my actual married name. And so at Nikki R1 on Twitter. And I do post about my research there. In fact, Caitlin, my pinned tweet is this paper, so you can go take a gander at that.
Beautiful.
And those are probably the two key places. If you're an academic, you can find me at ssrn.com, any of my working papers or some of my prior work as well. And if there's a paper of mine you're interested in reading and it's paywalled by the journal, just send me an email and I'm happy to send you a PDF. So.
Awesome. Well, thank you so much. Thank you again for being on, and thank you to everyone for listening. We'll be back next week with another episode.
Thanks for having me, Caitlin. It was great fun.